Hey, everybody. Welcome to week 120. And so as you guys are ramping on here, just a reminder, Q&A, questions, chat, harass us. You don't have to harass us. I'm just saying if you're going to, do it in the chat. Also, a little bit of trivia. And this is thematic, okay? So yesterday evening, after the thunderstorms went through uptown, Charlotte FC played Chelsea in a friendly, which is kind of cool. I mean, they're, one of the top EPL teams out there. Two questions. Hit us in the chat with this. Does anybody know, without Googling it, what the final score is? And even more importantly, and this is where the theme comes in today, does anybody know why this color selection was made as one of their kits? This particular color of green and black. Hit us in the chat if you know. And it has to do with the Queen City. And it happens to do with what we're talking about today. So here's the hint. Ben McDonald, the head of BGW Wealth, great guy, and also my cohort in the podcasting world of the Anything But Typical podcast. If you're not listening to that, please do. We've got another one dropping next week, but right now I think we've got Roddy Player on, don't we?
Yep, that's the last one
Roddy Player. Yeah, Queen City Appliances, and they came through for me in the supply chain mess when my microwave blew up. Didn't blow up, but it just quit after 17 years. And Best Buy dropped the ball, and guess what? Queen City not only had this particular one that only fits in this very specific thing that our custom cabinets were built around, evidently, but it was $20 cheaper than at Best Buy. Queen City, love it. So anyway, also Jack Santaniello is not with us today. He is out doing something really fun. And I'll show you a picture. I just want to know who picked the color of the Jeep. So he's with his family and he's doing the pink Jeep tours out west somewhere. And it looks like a lot of fun, but I just want to know, I have a feeling his wife won on the selection of which Jeep tour
having lived there, you don't have many options. It's called the Pink Jeep Tour for a reason. And it's
is it?
Yeah, so he did not have a whole lot of options out there. He got what he got.
Well, it's a good marketing thing. I mean, it kind of sticks out. And they could have called it the Pepto-Bismol Tour and, gotten some co-branding.
Yeah, and get some naming rights out of it.
Yeah, I mean, what were they thinking? Oh, well. So before we turn it over to Ben, also, we do have some polls. And I'll launch some of those, but Adam is with us. Adam, you got any thoughts on what's going on in the world, whether it be supply chain, inflation, recession, taxes? Because guess what? September 15 and October 15, which are the next two deadlines, are coming. Any thoughts that you want to talk about, Adam?
Yeah, a couple things thematically that have come up, which will then be kind of a segue into Ben. First, on the topic of inflation, we've hit it over and over again. I'm just, it's a reminder because I got to say it out loud like 20 times myself to, let it all sink in. I'm raising interest rates to encourage Gary to stop buying more stuff because he's going to hold on to his money.
But I need some free money from the government.
So that the supply chain has a chance to catch up, so the prices fall back down. So I reduce demand, but I do that in such a way that our consumer-driven society, which is driven by Gary buying stuff, doesn't stall out. That sort of feels, again, that feels like I'm not a pilot, but that feels like very much one of those sort of, I'm going to induce a stall, but then like not crash type deals that's going on right now. So, it's just a reminder of that, but how that relates to tax rates, you know, in particular is, you know, the jump there, what, you know, it looks like, courtesy of Senator Joe Manchin, you know, any movement at all on anything related to taxes, out of this particular Congress and administration. I mean, I feel like it's absolutely dead through November now at this point. Like if there was, you know, if there was any question, I mean, so I feel like we got what we got, you know, definitely through 2022. And I mean, I can say that with 100% certainty. And I can say we probably got what we got through 2023 with like 90% certainty, just based on the track record of how long it takes to actually pass something. And then once you do pass something related to tax rates, how often it becomes retroactive, which is basically we make it through April of next year, chance of it being retroactive or like almost uncertainly not going to be retroactive. So feel pretty good from that standpoint. I think the question that's come up within our client base pretty often has been like, look, my employees are feeling it, you know, at the gas. Yeah, you see the dog there in the background. Yay.
Chewy's doing pirouettes in the corner.
Yeah, I'm on dog sitting duty again. I swear I didn't train her to do that. She's just a knucklehead. You know, a lot of people have said, is there anything that I can do for my employees? You know, obviously, you know, the absolute black and white correct answer would be, you know, just give them more money through their paycheck, but that's got tax consequences associated with it. You know, the other thing you can do is like implement like a temporary auto reimbursement policy. You know, if you wanted to put it in place, but then take it away later, as long as people know that it's temporary. You know, the IRS mileage reimbursement rate just went up to reflect gas price differences, or maybe just say, look, you know, we're going to do an across the board auto reimbursement policy at $200 a month, you know, or something like that. So, you know, there's stuff, everybody gets a, you know, $200 Amazon card that's not reportable, you know, to offset it, but still a deduction for you as a company. So the answer to that is there are ways that you can still get a tax deduction without having it be taxable compensation to the employee. But the real things to remember is that if it's going to be like an auto reimbursement, then, you know, there's some documentation required. If it's not going to be an auto reimbursement, it's just going to be a gift. Remember, your cap is, depending on the style of gift that you're going to do, just remember that $1,000 number per employee. You don't want to trip that, otherwise it's becoming reportable. But related to the Ben, and you know why we brought him here in the first, we're always welcome to have Ben, but you know, just to, you know, for me personally, it's been a fabulous help to have Ben be a part of the team, because I found with a lot of our clients, you know, I was stuck giving financial advisory advice, and you know, frankly, you know, I unashamedly admit it. I should be better about this, but usually when people ask me the question, you know, what should I do with my money? My answer's been, market's been overvalued for 10 fucking years. Sorry, my language really let it go on that one. Sorry about that. Market's been overvalued for 10 years. Don't ask me, because I would have told you to get out 10 years ago. None of it makes any sense to me anymore. So I was not a good person to ask for advice. Because I was definitely a put it under the mattress while having a fundamental belief in the markets. I was a put it under the mattress type of guy, which is not the right answer. So all that being said, what I found personally interesting that I'm looking forward to hear Ben talk more about is that, you know, I, as a CEO, and then also as a guy that owns a CPA firm, I've been listening to economists, you know, for a long time, try to predict the future. And pre-COVID, pre-Trump Tax Cuts and Jobs Act, they were always saying recession 12 months away. Like, this is like first year of the Trump administration, recession 1 year away. It was pretty much a universal theme. And these were from people who usually had a track record of being right. Tax Cuts and Jobs Act happened. They said, well, it temporarily delayed the recession. It's still coming. COVID happens. They went, I don't know, you know, So it's just a reminder that, the markets do have basic economic cycles that have always happened since there were markets, so can't go up forever. At the same time, it's been proven time and time again that market timing doesn't work, because if you would have listened to my advice, which is you should have gone to the mattress 10 years ago, you would have missed the best bull run that's ever happened in our lifetimes that, I'll probably not see again. So with that in mind, that's why Ben's here, is to make sure that people don't listen to my advice on things that I'm not the expert in. And I did caveat that always, by the way, and listen to Ben instead. So thank you for that.
Yeah, for the same reason that I shouldn't be giving any tax advice either, right? It's like, oh, go talk to Adam. Adam's going to know infinitely more about this than I will.
That's right. That's why Adam's on here. That's why he started this firm. Oh, man. Hey, before we launch into Ben, letting him do his thing, tee up your questions, by the way, and I'll give you some thought starters here. So here's what Ben has been hearing. A lot of us have been hearing this, but especially some of these are very geared towards Ben. One, are we going to have a recession? Guess why we've been doing the last 5. We don't know, but it sure feels crazy out there. All right, so that's one question. What should we be doing with everything going on? That's why we're doing this. I don't know. We don't know either, but it does help to talk about it. 3, Ben question, should we be going to cash? 4, Ben question, how can we take advantage of this turmoil, especially in the markets? And the final one, what's going to happen with the housing market? We need the great Karnak and his infinite wisdom and sealed envelope. Who knows? There's speculation out there, but we'll talk about that too. And for those who did not answer, hit us up at the end on the chat. Does anybody know why this color of green was selected to be Charlotte FC's? It has to do with the theme of today. All right, so I'm going to go ahead and launch the polls first. I think it'll be just really interesting to see what happens. So the first question is, well, let's see I've got 3 questions here. Is your industry recession proof? Yes, no, or I sure hope so. Please answer. Hopefully this is enabled too. I don't know why the chat was disabled, but it was. 2, where do you primarily get your news and information? This is kind of fun. Mainstream media, including social channels, liberal media, including social channels, conservative media, including social channels. I don't follow the media. I have other sources. And the final question is, where do you primarily
It's the same one.
Oh, what happened?
You really liked that question, Gary.
I really liked that question. Oh, I know what happened. It didn't take it when I was putting it in there first. So I guess we just have 2 questions. Just ignore the third one. There's a Gary Senior moment, evidently. Okay. Ooh, keep going. I am very interested in those who have recession-proof industries. I want to hear what those industries are. Hit us in the chat. If you answered yes, we got 4 more that have not answered. If you want to, go for it. If not, that's okay. But I am very interested in, and you can remain anonymous. That's okay. But if you have an industry or you're in an industry that's recession proof, I'd be very interested in hearing that. Mainstream media, a lot of people, conservative media. I don't follow the media. Excellent choice there. Okay, cool. All right, 15 seconds. And then I'm going to shut the poll. Anybody else that wants to hit that? Let's see what's happening on chat. Ah, yeah, that's good. Well, Robert Marietta, he said that BGW is recession proof. How were we affected at all in the 08, 09, and 10? Adam, I'm just curious.
It's a good question. We're recession proof in the sense that everybody needs it, even though nobody wants to have to pay for it from a tax return perspective. So our impact was more around our clients' inability to pay, or us doing a fee reduction, or still having to do raises, but we couldn't really do a price increase associated with it. Or clients just went out of business. So, also, we didn't win a lot of, we still grew, but we didn't win a lot of new clients because, our primary thing is tax savings. But when you call up a guy like, hey, I can save you a lot of money on taxes, and the answer is taxes. I've got nothing but losses. I ain't gonna be paying no stinking taxes for a while. What else you got?
Yeah.
So.
All right, this is really interesting. I'm going to share the results with everybody. So 4 of you answered that your recession proof, your industry is recession proof. It's just interesting to see where people get their information, and it's not a comment whether one's good or bad. I mean, quite frankly, but what we do listen to definitely impacts our bias. No ifs, ands, or buts about it. So the recession proof industries, a couple of them that have answered here. So one is cash machines. Very interesting. Joe. That makes sense. You got to go to the ATM, get cash. Stuff that supports the banking industry. That makes sense. Also, we had professional salon products. People still need to look good when the economy is slowing. Business may be slow a little bit, but it does continue. That's great. Yeah, people's hair keeps growing. Unless you're mine, then I just sheared upstairs. But so that's good to know. I think it's interesting because pay attention to those from an investment standpoint. Again, I'm not giving you investment advice. I did have my licenses at one point, and I was happy when they went away after the last recession. I still have PTSD from it. That's why Ben is running that division, and he's doing a much better job than I would have. And then the final note here is from Robert Mayetta: with the yield curve inverted and short rates continuing to go up, at what point does this point to a bottom equity market? Excellent question. Okay, so you want to start with that one, Ben?
Well, let's start with some of the earlier ones, because that's almost like the next layer after the recession question, right? It gets into specifics. It's first of, hey, are we seeing it? If so, how do we handle it? And then how long is it going to be, basically? If that makes sense.
Yeah, that makes sense. Also, one final thing, and then you can have the reins in the chat that is now enabled. Thank you very much, Joe. Joe, you point out a really good point, and that is, if anybody has not listened to the Anything But Typical podcast, and it's not just a shameless plug for us, we don't monetize it or anything like that, but it's filled with really cool stories. But Roddy Player, which is the current episode, we launch a new one every 2 weeks. This podcast, they just celebrated 70 years in business, which is really cool. 70 years. And Roddy talks specifically in that podcast about what they did during the last recession. They lost 70% of their business within 1 year. Just a spoiler alert, but he talks about what they did there, but also what he has done in COVID. They learned from the last one and what they ended up doing in this one. I will leave that as a teaser for you, but there's some really nuggets of gold and wisdom in there. So, all right, I've talked enough. Ben, you take it.
All right, sounds good. So I put down the questions that you said earlier. So we'll start with the really basic one of, are we going to have a recession? So again, that's the whole crystal ball thing, right? But at this point, most analysts, Wells Fargo just changed their analysis. Bank of America has already said it for a while. Most are saying that we're going to see a mild recession and that it's going to be announced in 2022. So the literal definition of a recession is a little bit more vague, but the general definition is when you see 2 consecutive quarters of negative GDP growth, right? A recessing growth in our economy. So if you just take that as like the general rule, we're probably already in it, right? Because it probably just hasn't been announced yet. Doesn't mean that that's going to dramatically change things. It's just all information is lagging. You look at Q1 and then a month and a half later is when everything gets announced. So there's a good chance that already in 2022, we've already seen that. And like I said, pretty much everybody is saying we're going to see at least a mild recession right now. There aren't a lot of people saying, a lot of analysts saying that it's going to be a severe recession. But at the same time, we're already seeing just for this year, the stock market down anywhere. I think S&P going into today was down 17, NASDAQ's down 24% for the year. We're seeing bonds down double digits as well, right? So we're already getting hit decently hard compared to what we've seen for the last 15 years in the market. But understand those are not directly connected. They're correlated for sure, but a recession happening or not happening doesn't directly dictate what's going to go on with investments and with the markets. And what we're going to talk about later is it affects different types of investments pretty differently. So when you say, what should we be doing with everything going on? This is where what you're doing from an investment standpoint becomes much more important than probably a few years ago. And the reason for that is I'm going to say true diversification. And what I mean by that is in the past, what most advisors and most firms talk about when they talk about diversification is stocks versus bonds. And that's extremely basic. But people will say, oh, I've got a 80-20 portfolio where I've got 80% stocks and 20% bonds. Well, your 80% stocks could be all really large dividend paying companies, or they could be all very small emerging market companies. And those shouldn't be lumped together. And when you talk about bonds, well, bonds were for a while the safe haven, right? They were kind of the buoy in the portfolio because there was no inflation. Interest rates were really low. So you could go get a bond and pay a few percent, but you know it's not going to move, right? It's not going to drop 10% like it is this year or 12 or whatever it's at now. So we need to start looking at, or we already should have, but people that are on here need to start looking at their portfolios of going layers deeper when we're talking about diversification. So let's start with stocks. And we'll start with just large companies here in the United States. When you look at growth companies or small companies, right? So growth, I mean Amazon, Netflix, Google, companies like that. And then you look at small companies, both of those, their value is based off of the future. So if we are in a really good economy, the future outlook looks great. So the stock prices of those companies go up much faster than anything else. So that's why we saw probably from last year to maybe 5 or 6 years before that, those types of companies were the best performers. And it was because we were in a really good economy. Everybody's outlook was good. The sentiment of, are we going to have a recession in the near term, was extremely low. And so those companies grew really fast because the future outlook looked great. Well, this year we've seen the opposite of that, right? And I think I saw something the other day where like up to 89% of consumers in the US now believe that we're on the wrong track from our economy and that we're going to go into a recession. So almost everybody thinks we're there or going to be there. That means that companies like, and I'm using Amazon and Google as examples just because they're really large, well-known brands, but those types of growth companies, they're going to typically in this type of economy go down significantly more because now all of a sudden the outlook isn't as strong. On the flip side, you look at large companies And again, I'm going to use these as examples, not as recommendations, but companies like Microsoft, Coca-Cola, Verizon, Apple, those types of really large brand names that pay some sort of dividend, have a really healthy cash flow. They're increasing their dividends by more than what inflation is. When you have triggers like that, and they're in a great cash flow position, and they're not only relying on the future, they're actually making money and they're profitable now and giving it back to their owners through the dividends. Those companies don't fluctuate nearly as much in a recession or in a down economy. So when I say true diversification, that's one example of, you can't just say, I'm going to own large United States companies. You have to understand what type of companies you're owning. When you talk about fixed income, and I changed from saying bonds to fixed income for a reason here. When you say fixed income, you can't just own bonds, because when you own a bond, that's going to be negatively affected by inflation. So I'll give a real easy example. If you have one bond, Gary, let's say you own one bond that pays you 3% a year. I now want to go buy a bond, and the new bonds coming out are paying 5% a year. Well, why would I ever go buy your bond from you when I could just go get a new one that's paying 5%, right? Why would I ever take your 3%? That means the only way I'm going to buy yours is if you're giving me a discount on that, which means your bond price goes down. So as inflation is rising, as interest rates are rising, bonds are now being adversely affected and their value is going down. That 3% is still the 3%. You're still getting the same income, but if you ever try to sell it or trade it, you're not going to get as much as what you bought it for a couple of years ago. So I say fixed income because we can't just look solely at that one category of traditional bonds. We need to start mixing in things like inflation protected protection securities, or TIPS, where they're directly correlated with inflation. Their dividend goes up and their price goes up as inflation is going on, but it's still a debt product similar to the way that bonds work. We need to start looking at, do commodities make sense? And if so, what types of commodities? Do we want to go after agriculture, precious metals, or things like that? Because those in general tend to go up as we see rising inflation also. So we need multiple layers, and we need more sophisticated portfolios than what we did a few years ago. Because a few years ago, we could just buy some large companies that we knew their names, and we could buy some bonds and you'd be pretty set, right? Because there wasn't the volatility and all of these different factors moving on. So I just talked for a while, so I'm going to pause for a second. Gary, any questions or things you want me to dig deeper on more from what I just word vomited?
No, you did a great job of keeping it simple. You know, a lot of times financial advisors lose audiences, even sophisticated audiences, because there's a lot of gobbledygook. You know, like financial gobbledygook that just, but you did a good job in that. I think it's interesting. Here would be an interesting thing, and this is not meant to be a, you know, a lightning rod, but it's something I think about a lot, because when I was representing Sherwin-Williams, Martha Stewart went to jail for insider trading. She got her hand slapped, insider trading. And when I was at the banks, it was like very serious, you know, like any conversations that we had in management or whatever. I mean, they were going to come after you if you made trades or did anything based on insider information. And yet what's interesting, and I've got a pledge brother that is a senator, a US senator. And I'm like, how do these guys get by with having insider trading knowledge? And a lot of them make a lot of money in the stock market because they know ahead of votes, and it goes on both sides of the aisle.
Yeah, it was insanely prevalent in 2020 when you see the trades that happened a couple months pre-COVID, because it was happening internationally and there was more information out there than what the public knew.
Yes. And that just seems wrong. But, you know, when you've got people that can vote in their own pay raises and they can vote their they can stay in perpetuity. There's no term limits. It's actually terrifying. But wouldn't it be interesting if you had a fund that followed senators and how they're trading? I mean, maybe there is.
Yep. Yeah. So there's a quarterly report. Joe, we'll sell you some BGW stock.
Is BGW stock available? It's very, very expensive. You think Berkshire Hathaway was expensive? You have no idea.
But yeah, so there's a filing that happens every quarter called the 13F filing. And that's public. People can find that information. So anybody that's an institutional investment manager or a certain level accredited investor, public servants at certain levels too. I can't remember exactly how low that goes, but they legally are obligated to put out what trades they did for the quarter prior, right? And that's all public information. So yeah, there are definitely traders that go and follow that. But before everybody goes and runs and starts searching for 13Fs, understand that that's lagging. So
right.
The best example that I just saw a week or two ago on it was Ray Dalio's fund. What's the name of it? I'm drawing a blank right now.
I don't remember. I'll find it.
Hold on. It is Bridgewater. Thanks.
There you go.
Bridgewater Associates. If you look at their past either 2 or 3 years and you just followed the 13F filings, you only made like 1.5% a year, but they did significantly better than that. And it's because you're getting information after the fact. They could have bought and sold. They could have been doing strategies like hedging or shorting or things like that an average investor doesn't have access to. So don't just blindly follow those 13F filings or some representative that you've heard does really well in the past. That's all. So I just wanted to put that caveat out there.
Yeah. What I got alerted, hey, Paul Pelosi just dumped a bunch of stock, $5 million worth or whatever. He's going to go and buy NVIDIA prior to the Senate's vote on the CHIPS bill, which the CHIPS bill sounds great. Let's diversify. Let's bring chip manufacturing to the United States. I'm all for that. But there's a vote that happened at the Senate yesterday. It went 64-35 for it. And again, I think it should be for it. The question is why would members of Congress and their spouses have access to that? That just seems a little fishy, but it's beyond my pay grade and not a whole heck of a lot I can do about it. But it's interesting. I did send a note to Ben. Hey, should we do anything on NVIDIA?
Yep. And that's actually one of the stocks we've already got in our growth portfolio. But yeah, you had sent that message, I think, when you saw it over the weekend.
Yeah, that's right.
So
that's right.
One of the things that I think is really interesting right now that people have gotten into dramatically more since 2008 is real estate, housing markets, all that type of stuff being affected. But the amount of average investors that now own multiple real estate properties in addition to their primary house is at, I believe it's at an all-time high. So real estate as an actual investment, hard real estate, not just REITs, is more common than ever. So I wanted to make sure that we hit on what that all looks like. And so I got some of the stats before it. So first off, 30-year fixed mortgages right now are over 5.5%. I think it's 5.54% is the average. And because of that, the purchase and refinancing going on right now is the lowest it's been in 22 years. So we're seeing a dramatic slowdown in demand on the purchasing side of real estate. So like, for example, I've got some clients where they have a property. They've talked about the idea of downsizing their house because people are out or kids are out of the house, but they don't know when to sell. And so they like the idea of selling now because it's still near a high, but at the same time, they don't want to turn around and then buy a house because it's more expensive to buy than it was. So we've even got some people that are selling and going into some sort of renting situation, like condos or apartments or things like that, until it goes down. So it's a really strange environment that we're seeing of the prices are still high, but the demand is really low. And typically when we see that, you're going to see the lag of prices start to go down to match the demand, right? So that's one indicator that we're watching right now. The second is purchasing power. So a household that has a $75,000 household, which I think is just above median in the United States, they can only afford 23% of the houses that are currently on the market. And so purchasing power is significantly less. A $400,000 house, if you looked at buying a $400,000 house back in January of 21, and then you look at that same house today, it would cost you 106% more. And it's only been a year and a half. So because of those reasons, what we're seeing is a likelihood that we see housing market slow down. Now we're talking US numbers, right? Charlotte gets propped up a little bit because it's one of the fastest growing areas in the country. But throughout the country, we're seeing significantly less demand than we've seen in a very long time, in 22 years. And we're seeing prices and purchasing power or prices significantly higher and purchasing power significantly lower than ever before. So I wanted to make sure we hit on that too, because that's much more relevant than people just owning stocks and bonds the way that they may have 15 years ago.
Yep, good.
So what were some of the other ones, Gary, that you wanted me to hit on? I'm looking through.
Let's hit Robert Mayo's question about the yield curve.
Yeah,
being
that's right.
inverted and short rates continuing to go up. At what point does this point to a bottom equity market? Great question.
Yeah, really good question. And the tough answer is we don't know, right? That's the actual answer. Because it's how long does the yield curve stay inverted, which has a lot to do with how long we see inflation continue to rise, or do we see it settle back down to a much more manageable number, right? So that's one factor. The other, which isn't being talked about a lot, is as we're seeing stock prices get lower, even if we're in a recession, if bonds are losing double digits as well, people aren't interested in investing. They are investing in bonds because they're just not getting nearly as much for it. And they're not as safe as what people thought they were because of what we saw for so long with low inflation, low interest rates. So that's a really hard, or like a non-answer. Sorry, Robert, but essentially we need to see how long that continues to see the inverted yield and how do people react to it. So my thought is it's going to point more towards, as far as the bottom of the stock market, it's probably going to be pointed more towards or correlated more towards the economy than it is just the inverted yield. And you're also going to see the bottoms hit differently for large companies, small companies, US versus international, large or growth versus value. You're going to see bottoms almost tiered, where some of them are hitting bottoms significantly earlier. They start their recovery before maybe a micro growth company is going to, right? That's going to have a tier a few months later. And so you're going to see that tiered out typically, is what that would look like. But because we don't know that answer, and anybody that says they do is just making things up, right?
Run.
Yeah, exactly.
They're a TikTok influencer.
There you go. You'll get there, Gary. You'll start being a TikTok influencer.
Yeah.
But yeah, so we don't know when the bottom's going to come. Anybody that says they do is lying to you. And so instead, the way that we need to be reacting to it is we need to be setting ourselves up for the current environment and getting as close to risk parity as possible. Meaning, how are we handling when the economy is growing versus when the economy is slowing? How are we reacting when inflation is rising versus inflation is slowing down, right? And think of that almost like a quadrant of those different dynamics. And if you can solve for each of them, your downside protection is going to be significantly better than if you just go with what I'll call a traditional model of like just large or just stocks versus bonds. So get as close to risk parity as possible, because we don't know what's coming next. We can tell you the current environment, we can tell you our projections. And so we're teeing ourselves up for that. But yeah, the actual answer is you need to be set up for multiple potential scenarios, because there are so many factors at play right now, probably more so than ever since 2008.
So I love your quadrant idea. Restate it and if anybody has a pen and paper, write it down. So let's start with lower left quadrant.
Okay. Yeah. And I wish I could do a whiteboard on here. Or maybe I can.
Let me see if
That's okay. I'll just talk through it really quickly. So, okay, let's say on the left side, you have high inflation or slowing inflation, or growing inflation or slowing inflation. And then up on top, the two things that you have is economy is growing or economy is slowing. So that means the mix can be the economy can be growing and you could have high inflation, or economy can be growing and you have low inflation. Economy can be slowing and you have high inflation. That's what we're currently in. Or economy could be slowing and you have low inflation. So based off of all of those, you're going to have different investments that do better. So that's what I meant by that.
Okay, cool. I like it.
Yep.
So left grid, inflation, high, upper left, low, lower left, growing, right, lower right, slowing, lower left. Oh, there you go. Look at you, man.
We can get it figured out.
I like it.
So I can keep talking as I'm doing this, but just to let people see. The other thing,
Okay, well, yeah.
the other thing that we didn't hit on a ton, I was talking about different types of like large companies, right? And I'm saying things that are US based. But one of the pieces that I can't remember if we talked about last time I was on here was the US versus international. So something that very few people know is if you look at the companies in the S&P 500, 40% of their revenue comes from outside the United States. And what's happening is if you go get a just traditional investment portfolio, that's not being factored in. So you're getting 40% exposure to the revenue if you own large US companies, essentially, right? If we say S&P 500, plus then advisors are going out and they're buying 20-25% international companies, and you end up double dipping internationally because most people are only looking at where the company is located, not where they're doing business. So that's something that I would say be concerned about, because a lot of research analysts are saying that international will get hit harder than United States during all of this. And if that's the case, and you're double dipping internationally, you're probably going to see a lower performance return. Does that make sense?
Yeah.
So that was the only thing. I couldn't remember if we mentioned that last time, so I wanted to put that on here.
Yep.
There, this is a very sloppy version of what I was talking about. Does that help? So we are currently right here. That was a terrible X, but we are currently right there. But
okay, gotcha. Okay, that helps.
Right. But based off of all of these, we're going to see different things do well. Right. So when we see a slowing economy and rising inflation, I mentioned TIPS earlier, the Treasury inflation protected securities, they're going up in this time. When we see low inflation and a growing economy, you're going to see bonds do really well in either of these. Bonds do great over in this one, low inflation and slowing economy. When you see growing economy and rising inflation, right, you're going to get different mix of investments. So that's all I meant is make sure you're talking, whoever you're working with to do the portfolio, make sure you're factoring in not only where we are today, but also where could we be going to get as close to that risk parity as possible.
Very good.
Yep.
All right, stop sharing that, and I'm going to launch another poll.
All right. Let me see if I can stop sharing it. Any idea how I stopped sharing it?
No. Let's see.
Having just done this yesterday for the first time, I think you just close it, Ben.
I just close what?
The whiteboard.
I know that's what I'm trying to do. Sorry, Gary, keep talking. I'll figure it out.
All right, cool. Let's see.
I don't see a place
Let's
to close
move.
it, Adam.
All right. I'm going to launch this poll over this. While he's
Sorry,
figuring
guys.
that out. You know, we have learned a lot in the last 2.5 years on this whole, COVID 2 weeks to slow the curve. Yes, it is our 120th week. And I know I mentioned it at the front, but it still kind of blows my mind. But we're still learning, that's a good thing. So I'm going to launch this poll. This is kind of fun. Go. What's the significance? Nobody answered, so I'm going to ask you. I'm going to give you some answers. What's the significance of this Charlotte Football Club color scheme? It's Tepper's owner, his wife's favorite color. It's the team's favorite ice cream, which is mint chocolate chip, or it's a tip of the hat to Charlotte's roots in the gold rush. You guys are smarter than the average bear. It's because you've been listening to these webinars, I think. All right. Yes. Y'all got it. It is a tip of the hat to the gold rush. Did you know on Mint Street, right across the street from a company that I used to run, now it's that building, it's now Boone Oakley at 1415 South Mint, but right across the street, it was a little service station or whatever. I don't remember what's there, but there's kind of a Quonset hut on that same side of the street. Behind it is the entrance to one of the main shafts of the mine. Interesting. And they have a bunch of cars like going like down into the shaft. I don't know. I would love to go down there. I'd love to see what that's all about. But I just think that's interesting. And the other thing that I heard off of a Segway tour a couple of years ago in Uptown on my birthday, which was a ton of fun, was that there are a lot of South Africans, or there are a couple big South African mining companies that are pouring gobs of money right across the state line into South Carolina in gold mining. That's what I've heard. So I heard it from the Segway guy. It was actually pretty interesting on the history of Charlotte. So anyway, you guys are smarter than the average bears. That's good. Any other questions that you might have for Ben or for Adam? We'll save the legal questions for when Jack returns from the Pepto-Bismol Jeep tour.
Yeah, I will. I mean, maybe, so one of the things that I also, when I was playing a financial advisor on TV, for our clients before you came on board, Ben, I mean, and I still get asked the question today when it comes to, contributing to a retirement plan. I mean, here's the way, again, this is my wonky how to answer the question about, supercharging a retirement plan. So this is your opportunity to also correct me. If I'm a business owner fully charging my retirement plan, there's well, should I do it because it's prudent and it's a good savings account? The answer to that is, yeah, if you weren't going to save your money anyway, you absolutely should. On the other hand, you're a business owner and right now you've got a historically low tax rate. If you're the right type of business, you're paying 80 cents on the dollar. So you're basically saving money at a 29% rate to then potentially pull it out at a higher tax rate, all the while going into a potentially downturn market, blah, blah, blah. If you have to pull it out at a higher tax rate, the market's going to have to outperform what it's historically performed, blah, 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 blah. And then I, lose people probably right at that point. My point in saying all that is that I had someone ask me the question once where I was like, yeah, you're probably right. and it was a guy that was about my age. It's like, yeah, at the end of the day though, does any of that matter? Because I'm not going to pull it out for 20 years anyway. So if you could talk a little bit about, more about like, how much does your age weigh into how much administrations come and go, recessions come and go. If you kind of weigh into, your age and not to get really precise, but kind of, maybe 5 to 10 year increments from like 70 to 35, what, kind of, kind of share your opinion on like, this matters or it doesn't freaking matter, at the end of the day. Cause
Yep. So I'd say age is probably the largest factor in how you're saving, especially in the 401ks, right? So if you have a longer timeline, one of the things we're doing with every 401k that we're opening up with people now is we're making sure that it has a Roth option, because having a longer timeline, without spending too much time on this, a Roth IRA, Roth 401k, any of that, the growth grows tax-free as long as you leave it in till age 59 and a half or older. So if you're a 35-year-old and you're not touching this money for 25, 35 years, and you put $20,000 in and never contribute again, and that 20,000 goes up to, let's say, 100,000. Well, that $80,000 is all then tax-free, right? Versus a traditional IRA or traditional 401k, it's all tax deferred, right? And so with that, you're pushing off the taxes, and that's where you get into what Adam was just talking about of what happens if you end up taking it out at a higher tax bracket or higher tax rates, right? If tax rates are growing. But the other thing to factor in is what's your income going to be like as you're taking it out, right? So if you have no source of income by the time you start taking it out, then yeah, maybe all of the tax rates are higher, but yours may be relatively lower than what you're currently doing versus if you're working full time and you're at the highest tax bracket, for example. So timeline and age, I would say, has more to do with how you're investing it, meaning are you putting it in the Roth 401k? Or are you putting it in the traditional? If you're in that in-between phase where you're in a high income bracket, but you've got some time, are you bridging the gap and doing both? Are you saying like, okay, I'm going to do the Roth contributions in my 401k, and then I'm going to get the tax benefit from the profit sharing piece of the plan, right? Things like that. So essentially, the closer you are to retirement, the less it makes sense to do Roth, the more it makes sense to do traditional. And reverse of that also would be, it may not even make a lot of sense for if you're 5 years out to put it all into a 401k. Maybe you want to save some of it in a brokerage account. You pay the taxes now, and then you just have to worry about capital gains in the future, right? So there's that piece too. The closer you are, that becomes more relevant. Does that answer your question, Adam?
Yeah, I think it does.
So here's another question for you, Ben. Crypto.
Yep.
Lots of crazy stuff happening in crypto. Lots of people, TikTok influencers, actually know one young guy.
A crypto TikTok influencer?
Well, he was an influencer before that. And so he would,
okay.
Be shirtless and with his girlfriend and all that kind of stuff. And like, he literally makes over $1 million a year on freaking TikTok. Just blows my mind. But then he got really big into crypto, and he's living lifestyles of the rich and famous, at least it looks that way. But there's been this massive shift. I just saw a news thing hit yesterday where Elon moved all of their digital assets, or 75%, I think.
They sold 75. Yeah, they sold 75% of their Bitcoin. Tesla did.
Oh, they sold their 75% of their Bitcoin. So can you talk to us again, people? This is not investment advice, blah, blah, blah. Disclaimer. But just give us some thoughts and observations in this really weird world.
Yeah. And I don't even think I told you this, Gary. Yesterday, I completed the certified digital asset advisor course. It was a 6-week course and then take a test at the end and all that. So I actually got certified in being able to manage cryptocurrency, digital assets, things like that. And it finished yesterday. So
Oh, cool.
now I've got a
Congratulations.
certification to go with whatever I say next.
You could
So-
be, you can't be an influencer on TikTok because certifications, they cannot have anything of any credibility.
Correct. Yeah. And this is a much longer conversation because there's so many different levels of the cryptocurrency itself, right? You think Bitcoin, Ethereum, Litecoin, things like that, the blockchain technology behind it. And then we're seeing more of things like NFTs and DAOs and things like that. So it's just, there's so many layers to this that we could talk forever about it. Essentially, in theory, things like Bitcoin or Ethereum should do well, similar to commodities, as you see high inflation. The problem that we're running into right now and why you're seeing things like Bitcoin go down as the markets go down is because there's so much unknown about it and it's so new that it's just too high of a risk. And to be fair, the same thing happened with things like gold. When gold first got traded, it was extremely volatile, right? Because it was new to be trading. Nobody really understood the exact value of it. And so you'd see massive price swings. And that's what we're seeing now. So in theory, things like cryptocurrency should do well as we see rising inflation and as we see an economy slowing, because you get the pieces of it's decentralized, it's not it's the technology behind it is significantly more secure than our current financing and banking systems, where it can't be hacked. People can't steal the same way that people steal or hack into our current systems. So because of all of those things, in theory, we should see it going up right now. We're seeing it going down because it's so unknown and it's so new that nobody understands the actual value of it. So we're using it almost like you have to check the other boxes first. Do you have a truly diversified portfolio? Are you in a risk parity standpoint? Do you have multiple forms of income? Do you have a healthy cash flow for yourself as an individual or for a company? And then if you do, does it make sense if you want to be higher risk and long-term to own 3 to 5% of your portfolio being in crypto? Then it becomes a conversation. The problem is people are trying to get into it when they don't even have a fully fleshed out portfolio yet, right? They just want to gamble. And at that point, that's what it is, because we have no idea what's going to happen with the crypto pricing in the short term because it's so unknown. The technology behind it will be around, right? Whether Bitcoin's around or Ethereum's around or whatever, that's a longer conversation. The technology behind it, the blockchain technology, in some format, we will all be using that. Like that's basically a given. The tech there is infinitely better than what we're currently using, but it's how do we end up using it and which ones end up winning? That's the bigger question. So I think it's more about, you may want to have a little bit of exposure to it because of that technology, but not before you're doing anything else. And if it's money that you're completely fine not touching for years.
So good question. We got some good questions in the chat as well as in Q&A here. So dovetailing into this crypto thing, this is a really interesting question, Joe.
Yeah.
Will companies need to accept digital payments going forward? How do you do that?
Eventually the answer will probably be yes. But right now we'll use Bitcoin because people know Bitcoin. Bitcoin 6 months ago, let's say I'll try and make it even more simple. Let's say 6 months ago, 1 Bitcoin could buy you a car, right? Or let's say it could buy you 5 cars. 1 Bitcoin could buy you 5 cars. Today, that same Bitcoin could only buy you 1 car, right? Because it's down so much. So when you use it as currency and it changes from day to day, like if you go to buy a hot dog and it takes you 1 Bitcoin to buy a hot dog, and the next day that same Bitcoin could buy you 4 hot dogs, you can't use that as currency because it's so volatile from day to day. and currency needs to be more stable. So eventually, yeah, we'll accept, I'm saying we as in like just businesses in the United States will accept digital currency as people being able to pay for products or services. We're not there yet because it's too volatile from just the day-to-day movement of it. You can't use it as a currency.
Yeah, and I'll weigh in on that. I mean, the number, like we've got a handful of clients that do business internationally and, have to accept payments in international denominations and invoice denominations. And those are relatively stable markets.
Yeah.
All of them, none of them ever bought a hedging product that worked, because, you invoice, for a dollar, currency fluctuates, and then you lost money when you finally get paid, and then you lost money again, by the time that you actually translate it back to a dollar. And, the hedge is supposed to protect you from all that, and it never freaking works out in your favor. And that's with stuff that doesn't fluctuate very much. Like the number of clients that we have that do business internationally that are happy with invoicing and receiving payments in foreign denominations is zero. So given they'll always pick dollars if given the option. In addition to that, it's like the number of clients Ben's probably had that have made money in foreign exchange trading is probably zero.
Right?
Because it's so, so I kind of, that's one where I will pile in on as kind of a subject matter expert, having watched people have to deal with foreign currency, because it's the equivalent problem of a foreign currency.
Right. Just multiplied by 10,000 because it's so much more volatile. Yeah.
Yeah. So they're like, in other words, if you plan on paying your bill in Bitcoin or BGW, I would tell you there's no chance that's happening anytime.
Yeah. I don't know if any of you have seen what some professional athletes have done, but they've actually done their contracts to be paid in Bitcoin instead, which was them doing a bet on, hey, Bitcoin's going to rise in value. Well, the way they did the contract was back whenever they signed it, it was $1 equals X amount of Bitcoin. Well, they've lost, their contracts are now worth like 70% of what, or no, it's like worth 30% of what it was when they signed it. So they've lost millions and millions of dollars because they had agreed to a contract at a certain time, and it was the exchange of US dollar versus Bitcoin. It just like US dollar versus yen, right? That exchange was whatever it was at the time. So they entered the contract, and it's way too risky for you as a business to do that right now.
Right. Yeah,
Man, we've got two more really good questions, but we're already past. So I'm almost thinking we need to do an encore because there's a lot of stuff here. So I'll address them real quick, and I don't know if we have time to answer them, but first question is Roth account. What age do you consider older? Well, I'm 60, and I'm definitely not in the older category. I was
going to say that question could get me in trouble, right?
Yeah.
Yeah, it's less about age and more about timeline. This is a really easy one for me to answer than anything, but you with where our tax brackets are, if you just take an average individual or average household, I believe the break even from Roth versus traditional is like 7 or 8 years of a timeline, where it makes more sense to do a Roth than it does to do a traditional. And those are on estimated figures and all that, of course, right? But it's somewhere about that. If you have a timeline longer than 7 or 8 years, it starts to flip towards being more beneficial to do a Roth.
Yeah.
No, Joe, you are not older than dirt.
Adam, what were you going to say? Did you have something else?
I was going to chime in on the second chat after Gary reads it.
Yeah. Okay. So the next one, Bruce, we're not going to make you wait. We see the forecast that due to inflation, COL for Social Security payments are going to be very large compared to prior years. It looks like it'll be expedited. It will expedite the forecast on the health of Social Security. Should we expect the next Congress to take this seriously in 2023? That's a loaded question.
We should have expected the last 10 Congresses to take
this. Exactly.
So I'll share my opinion on this one, which is, first off, so COL stands for cost of living, meaning they're making a cost of living increase in Social Security, which means that the number of payments going out is going to be greater. They're going to have to update when is it going to become insolvent. All true. At the same time, Bruce, while I'm not happy about it as an employer, one thing to consider is that part of what's driven wage inflation has been wage inflation. What's a funder of Social Security? Wages. So, I'd suspect that when they shake out all the math in terms of the raises that people have received, that's more money coming in than would normally have come into Social Security to help offset some of that. But, generally speaking, I feel like this is going to be one of those, when you hear Republicans being mad about entitlement benefits, it actually is not Social Security they're mad about. It's Medicare and Medicaid. And even then within Medicare and Medicaid, they're not mad about the disabled. They're mad about low income and long-term unemployable. So I feel like that on the Social Security side, this is probably going to be one of those fixes where, shot fired and we're all, shots not fired and we're all patting ourselves on the back, giving us a gold medal. And here's how the politicians will sell us. Well, so take Gary as an example. Love Gary. Gary, I'm about to compliment you and then also tell you about how you're about to get screwed.
All right, thank you.
In recognition of the conversion of our economy, this is sort of the Paul Ryan plan, by the way. In recognition of the conversion of our economy, into more of a knowledge worker society. So pat on the back to the educational system in the United States and all the funding increases for our beloved teachers, that we've had out there, pat on the back again. We've just realized that, when we first implemented Social Security and set the retirement age, where we set it, it was really an acknowledgement, that people were living really hard, lives and, weren't able to work as long as they want. But at the same time, we recognize that the birth rate in the US has declined a little bit, and people still are healthy and productive, given that the average age of Congress is freaking 65 or whatever it is. Well past 65, going to the 70s. Thus, we feel that it's prudent that for everybody that's, 60 or below, the new deferral retirement age that you can defer your retirement benefit until is now 70 and a half, so that it's aligned, back with everything else, or they'll raise like the RMD from 70 and a half up, and then align Social Security with that. And also, we're going to give you a tax cut over here, but by the way, we're going to raise the payroll tax rate by 1/4 point. Like all those things solve all insolvency for Social Security. Raising the retirement age a little bit, raising the payroll tax rate a little bit, all fixes the insolvency problem on Social Security completely, for a long time. I feel like that's what's going to happen is they're going to decouple the discussion to what it really is, which is, one side entitlement is not retirement and disability. It's specifically, long-term unemployed, unable to afford healthcare people that, could they get a job or not? That's not for us to answer on the call, but, that's really the issue that they'll leave on the table and carve it out is what I think will happen, with all that. Tirade complete, mic dropped.
That's really good. I actually like the 70 and a half because I have no plan on retiring. Lord willing. I'm having too much fun.
Well, no, I know it. I mean, not that I'm looking for reasons to emulate France, and they've got their own hot mess, but I mean, that's part of, France tried to implement an extremely logical approach to its own entitlement system, which is, way more generous than what we have here, which is basically your retirement age is driven by the labor intensity associated with your work. So it was an acknowledgement that, you know, if Gary's job is as a ditch digger, that is more physically taxing and your body's more worn out at 65 than if Gary was a college professor.
Yeah.
You know, all else being equal. So it, you know, it makes sense to me. Whether they do anything with it or not is a different story. But all the talk about how Social Security, you know, it's not going to be here for us. You know, at my age, I'm about to be 49. It's like, so, you know, there will be an insurrection if that happens, because Ben and I are going to be freaking pissed that we've been funding this. Like, you cannot, the reason that I believe there'll all be something is because you cannot take my tax money that was designed to pay me a benefit and then not pay me the benefit. Like, there will be an insurrection if that happens. That's why if you look at the federal budget, you know, tax receipts from Social Security are actually pretty damn close to tax receipts paid out for Social Security. So you can't keep on taking the tax money in and then stop paying the benefit out.
Yep, that's right.
Or then Ben and I will be marching in Washington.
Yeah, that's right. Adam and I will lead the way.
That's right.
And they probably will not be opening the door for you to go in.
Right.
Probably not.
Yeah.
So yes, Joe, you're right. There is a difference between retiring and taking your Social Security money. I agree, but I don't want to take it yet. But I want to hopefully let it grow. Thank you, man. This was fun. This was a good discussion. We'll probably have to do some sort of an extension of this. Just great questions. We're going to still be on this whole recession proofing theme next week. I just have a sneaking feeling that we're going to do that. So anyway, you guys be safe out there. I just saw that. Oh, you know, something we ought to talk about is commodities coming up. You know, JP Morgan has had their hands slapped on manipulating gold, which is interesting. Again, they just paid $920 million 2 years ago, and they're back in the news again for it. Not to disparage JP Morgan, but it's like, it's interesting. You know, these big players do have an impact on moves. Yeah. No doubt about it. And so what do we do about that? Because we're little fish in the sea. So another thing to think about. Everybody, thank you for joining us. We will put this up on the BGW CPA YouTube channel. And glad to see that Charlotte FC tied Chelsea last night. I didn't get to see it. They didn't air it. At least I wasn't willing to pay ESPN Plus money for it, but I saw the highlights and we tied it at the end at 90th minute, which is pretty cool. Have a great weekend and the rest of the week, everybody. We'll have this thing up later on today. Thank you, Ben. Thank you, Adam. You guys have a good day.
Thanks. You too.
Bye.
All right. Bye-bye.